Well, you're listening to Retirement Unlimited, the show where we walk through and talk about life's difficult questions to try and help you make smart choices with your money. This is Randy Barkley. I'm Jeremiah Lee. We're both certified financial planners, and I'm also a California licensed attorney. And we work together. We work at Tricord Advisors. We guide clients through all sorts of stuff. And
Jeremiah, I think the biggest issue right now that's going on, of course, with these rising interest rates and the Federal Reserve is trying to slow inflation down. That seems to be the number one enemy right now. I mean, it seems to be the target.
And they came out last week saying that we are doing this. I mean,
right.
Jerome Powell, I think his comments, no one walked away uncertain. They're going to deal with inflation.
Yeah, there's no ambiguity in his comments. And now the advantage for savers for the first time in almost 10 years, in fact, even longer, it's going back probably to 2008, savers can actually get some interest on their savings at the banks or whatever.
Right. Well, that's the hope, right? We talked about the internet banks and some of the smaller banks. They are up to almost 3% on some of these savings. But the big banks, and we've had a few clients have talked about this, they're not there yet. Like they are keeping their savings deposit return rates low.
It seems like the bigger the bank, the less willingness they have to increase interest rates on depositors' money.
And it's a quandary, I think. I mean, I think there's a lot of money out there that wants to find its way into CDs or find its way into banks.
Money market accounts.
Yeah, people want to be secure. They want to have something out there. But there's, I don't know, it's fear, but people don't want to necessarily be in the market with it being so volatile. So they're looking for those. But I mean, an article I read about that was making a comment saying some of these big banks just don't need the extra money. Like they already have investments made. They're making loans. They don't need extra funds to make more and more and more loans. So they're not paying a whole lot in deposits.
Yeah, we talked about liquidity, and banks have got a lot of money. Of course, individuals have got almost $1 trillion more than they would normally have. And a lot of that excess liquidity, of course, that goes into banks.
Yeah.
And if you're dealing with a large national bank, where most people probably are making their deposits, banks are going, we don't need to increase our interest rates. And they're just fine. They're just fine doing that. So,
yeah. We're here talking about today, real estate and
interest rates, and just what's going on in the general market.
Right. And these are the things that really hit most people's pocketbooks.
Exactly.
They impact people's lives. And one thing we talk about with savings is what do you do when you're trying to get into your first home?
Right.
For a lot of folks, they're in a home, right? They're already there, but they have kids, they have grandkids who are trying to get into this first home, and they feel the pain of this.
Yeah, because I mean, the prices of homes in some of the hot areas are starting to decline a little bit, or they're not having to compete with multiple buyers. But now with interest rates going from below 3%, not all that long ago, and now all of a sudden they're over 6%, heading north to 7%. Your price as far as what you have to pay on a mortgage dramatically increases. In fact, in some cases, it's a fairly, it knocks you out, basically. Yeah. It knocks you out of the competition to buy a house.
Absolutely. Some of the numbers I saw was, $350 a month.
Yeah.
Just because of the raised interest rates. And that takes something out of affordability for a lot of folks.
It does.
And I mean, there's a bunch of stories I'm sure people have heard that we hear. There's a story in one of the papers we read that was talking about 14, this family had to beat out 14 of their offers. They'd done house after house after house, couldn't get a house, first time home buyers. So finally, there's a house, 14 offers are in, and they just said, we have to get something. And it was like a panic buy.
And they threw numbers at it until they became the people at the top of the list, so to speak.
And then now what? It's almost like you want it, but now you have to make sure your life fits that. And that's a tough moment, I think, for a lot of people, especially first-time home buyers.
Yeah, and I think, again, my comment always has been is that the acquisition is the cheapest part of the transaction. Because once you get the home, for example, if you're buying an older home, you're probably walking into some maintenance issues. And so air conditioning has to be replaced, roof has to be repaired, maybe plumbing issues, electrical issues. And most first-time buyers, they're excited to have a house.
Yeah.
Now all of a sudden they've got the mortgage payment, but now they've got other expenses and such as that. And I think a lot of these people, they're probably walking in blind to some degree.
Yeah. No, that's right. I mean, kind of told a story. Our first house was built in the 50s, and we had a drain clog, from our sink. It was, I don't know what time of the year it was, maybe Thanksgiving or something, we had a clog. So a buddy of mine who's a plumber, he and I crawled under the house and, cut a piece of pipe out, and the pipe was, this big around.
Right.
But then the inside of the pipe, from all the years of corrosion and whatnot, the inside of the pipe was, I don't know, that big around.
Right.
It was not large. And it was amazing of that was the whole house,
right.
And so they were fine. They worked. Our pipes were sufficient, but it was something as a first-time home buyer, I had no idea to even ask about. And I was lucky that I had a friend who was willing to come over on a Saturday and help me.
Somebody you knew,
Yeah, and
right?
help me fix the
Yeah.
clog and fix the pipes. But yeah, it was something that I, especially as a first time home buyer, did not have, one, knowing how much that would cost, but then two, know that it was even, I mean, the pipes work, right? They're
Right.
pipes.
They're
And
pipes,
realizing
right.
that as an older house, there's all sorts of issues and maintenance issues.
Yeah, so people that are buying into a home right now, I think the key issue is should they go to some other form of financing, like adjustable rate mortgages? And these now are starting to become the preference because the cost of home has gone up and their affordability index, people are not still
Yeah.
quite there. And so they're looking, instead of a conventional, because conventional has popped up, should they go into an adjustable rate mortgage? And there's different parts to this. There's different kinds of adjustable
Yes.
rate mortgages and the requirements on that.
Yeah. And so the 30-year fix is kind of the classic, you say
Right.
conventional, you have 30 years to pay it back. The interest rate is going to be the same no matter what. These adjustable rate mortgages, I don't know when they first came out. I mean,
they came back. They were like, I experienced them. I saw them back in the late 70s, early 80s,
Yeah.
because interest rates were so high. There was a lot of, engineering,
maneuvering.
So
yeah. Basically, these adjustable rate mortgages, they'll give you an introductory rate
right.
for a number of years, and then it opens. It's whatever, it's a 10-year adjustable rate or a 5-year adjustable rate, which is very common. It then shifts to whatever the going rate may be, and it could be higher, it could be lower. And part of that is when the banks are saying the rates for a 30-year mortgage, they're having to project 30 years from now, what these rates will be. That's a good deal for them. Whereas the ARM, they're able to give a little bit lower, knowing that if for some reason they set it too low, they'll be able to adjust it. And so the bet, the risk here is, if interest rates go up significantly in the next 5 years, then you may go from having, the current rates were about 4.9% for a 5-year adjustable rate mortgage.
So explain that. I mean, make sure our audience understands it. So the rate will stay at that 4.9 or
4.9 for 5 years.
For 5 years.
And so it's a great mortgage compared to what else is out there. But at the end of that 5 years, it's in the terms of the contract of how exactly it swings. But usually it goes to whatever the prevailing LIBOR rate or some other standard, well-known rate, plus a couple of percentage points, and that's your new rate. So if interest rates increase between now and the next 5 years, this could go up to 7, say. And what that does to the homeowner is, maybe their payment was $1,400 a month is what they've been paying. All of a sudden, those 5 years expire, the interest rate shifts. Now maybe they're paying $2,100 a month.
Yeah, and it's tied to it's either LIBOR or some underlying interest number, and it's that plus something. And you have to be really careful that you understand how your mortgage will be adjusted down the road. Now, most people are buying it on the assumption, and could be wrong, that interest rates are going to go back down. And so that we're going to move back into maybe a recessionary period. The Federal Reserve will lower interest rates, and we'll be back into those 3s and 4s on conventionals. There's no guarantee that that's going to happen.
But that's the strategic choice. Someone who's doing this is probably feeling either, one, I can't get into a house. I can't afford a 30-year fixed rate payment. So I'm going to try this. Others just say, I'm willing to make a gamble here. I think we can do better here. And they're walking into this. And if interest rates go up, then there'll be an environment where they either have to pay a higher payment because it's adjusted, or try and refinance in that market, whatever that may be. I think a lot of these people are hoping that either the interest rates go down, or even if their loan isn't great, they can refinance into something different.
Right.
Their income's gone up, their situation's changed, something.
And I think it's really important for home buyers, particularly for people that are just starting out, that your home is really not an investment per se. An investment is something that will give you capital gain back or give you income. It'll give you some benefits as a real estate position. But your residence typically doesn't. You're not going to get income from your residence. You're not going to get capital gain from your residence unless you sell the home. So if your timing's perfect, you buy low, sell high. But during the time that you hold a real estate, you're also going to have additional expenses. You're going to pay the property taxes into it, the insurance, the maintenance, all the other factors that go into home ownership. And that doesn't include, the aesthetic stuff, landscaping, the other things that you put into your home.
In California, you have to water your lawns. If you bought a yard that actually had a grass with it. And then on the other side, the positive side is there's some tax benefits to owning a home.
There is.
You reduce your interest rates. The homes in American history, recent history, last 30, 40 years, owning a home has been a great wealth builder. And the home prices have gone up over time. People have built that. But you're right. It's a it's important to separate the idea of an investment from where you live.
Yeah, I see a home as a security. In other words, what you want to do is secure yourself from not from being a renter.
Yeah.
You don't want to be in a situation where the landlord has control of your destiny, so to speak.
Yeah. I mean, let's pause there for a moment. We have a number of clients who are struggling right now. They're the landlords,
Right.
and they have not raised the rent on their tenants for the
Right.
last couple of years because it's been COVID. It's a great moment of them. But now, as rents are going up, they're feeling, wow, I'm charging sub market rates on
Right.
the rents for the home I own. And so my options are either give this tenant a massive increase, or I'm going to have to evict them and get someone new, or I'm just gonna have to eat this and
Mhm.
continue to not have sufficient rent. And it's a really tough spot. And that's from the owner side. From the renter, you just if someone decides to raise your rent, you just get a notice,
Mhm.
and it says here's the rules. And there's protections in every state of how much and when and where they can do that. But even within the law, there's a lot of flexibility that gives people they can struggle, so they don't control their destiny as much as if they own it.
Right. And I think the key there for if you're a landlord, you got to be able to manage. And so many people that we talk to that bought a property or they inherited a property and they rented it out, oftentimes we find they don't manage it. They're not really keeping up on rents. They're not really going in.
Yeah.
And I said, well, your property taxes have gone up, your insurance has gone up, the cost of management, maintenance of that property has gone up, but you're not collecting the income that you should be collecting on it. And my comment is the renter knows. The landlord just doesn't want to have that conversation. Sometimes it can be a tough conversation with the tenant. But the reality is you have to manage that property to make it feasible for you to keep
especially
it.
for the long term.
Right.
And it's hard to think through, but the kindest thing often for a landlord is to keep consistent, regular increases so that they don't get behind. They don't feel that they need to make this massive change.
Right.
For their renter and put their renter in a real hard spot. And that consistency of knowing my rent goes up, 2% every year, most renters can factor that in, and determine that as we go forward. That's good.
So anyway, you're listening to Jeremiah and myself. I'm Randy Barkley, and we're here to help you we're trying to talk about things that we think are really important. And some of the things we talked about earlier was interest that you can get on your savings. We can also help you find places where you can get better interest and have a flexibility of assets. In other words, you can get to it, but also get an interest rate that's better than what we've seen in the past. And secondly, we're talking about the change that's occurring within the real estate market because of these rising interest rates, particularly in mortgages and such. If you'd like to know more about this and we'd like to be able to help you with it, give us a call. Our phone number is 951-684-7011. Stay tuned for our next section.